And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Everybody who's traded has gone through periods of time where their strategy hasn't worked.
Where if not a hard stop, you should reevaluate the trades you're in based on time.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Hello, everybody out there. Welcome to the Limit Up podcast. I am Jack Pelzer, joined not by Dan Hodgman, but by John Doherty. JD, how are you doing today?
Hey, Jack, feeling great. Thanks for having me back. It's been, I'd say, over a year since I joined you on the podcast. Happy to
I know
be here.
you mentioned that. Nothing bad happened last time or anything like that. We'd still love to have you on.
Thank you. I should have gone back and listened to it just to make sure, but I just didn't have the time today.
It's been a year. Everyone's forgotten. In the meantime, at the top here, I wanted to say that this is not live on YouTube. We are coming to you from 24 hours earlier at 3 o'clock on Wednesday, December 14th. So bear with us here. We don't know what crazy stuff happened tomorrow yet, but we're going to break down a little bit of the Fed stuff and talk today about what levels matter in a fast market, which is something that will be of special interest to day traders out there. But before we get started, we won't do a full recap because you already know what we don't. But we would want to talk a little bit about the price action today around the Fed and maybe look at some patterns in the equities. So JD, I understand you have a little bit of that to start.
Oh, yeah, just taking a quick glance at these ES and NASDAQ charts. Yesterday, if those, I should say Tuesday, after those CPI numbers, we tested the those highs going back to September. September 13th, I believe, is the last high the ES put in. And yeah, basically came right back in line. Right now, we're looking at the ES is up about 15% since hitting that October 13th low. So we're in a solid uptrend right now, just a mini uptrend. And I'm looking at this kind of broadening triangle pattern formation happening in the ES and the NQ right now. If you look just going back to mid-November to the last couple days, you could see this sort of mini broadening pattern happening.
Yes.
And it's right in the middle of this sort of congestion area going back to what is it? Early June, it looks like. But like I said, it's just a mini pattern right now. Usually you see these broadening formations happening at major tops and bottoms, but we see it happening sort of in the middle of a range right now. So curious to see what happens there in the next couple weeks. Momentum still pointing up. We're above all these short-term moving averages, above the 50-day moving average. So things are still looking pretty positive in equities to me right now.
Yeah, we got that double bottom down at 3,600, which has been the real kind of line in the sand here, where there's been one wick that pushed below it before it rocketed back. I remember that. That was on Veterans Day. That was when Dan had the bad beat at 3,502. He had to get below 3,500 and it came back above 4,000. But for closes, right in that range, not too far from 3,600, you got that double bottom, and then it has been in an upward trend. The real thing I'll be looking at, we are still just dancing around. I can't even see where it's at right now, but that 200-day moving average in the ES, that's been it's the magnet that's bringing everything back. We haven't been able to consistently get above that. Like a pretty bearish thing is just how, back in mid-August, the previous high that was at about 4,300, 4,320, something like that. It just bounced right off that 200-day moving average. And we haven't been above the 200-day moving average since back in March to early April, right? We've been bouncing off of it. So I would be interested to see if we can hold above that. Right now, it's sucking everything right to it, which is one of the levels we'll be talking about when we talk about fast markets. Is I noticed yesterday with the crazy CPI number, the action after that it did get sucked right back down to around that 200-day moving average. Before we go into that topic, though, something I've been interested about, I've been reading on Bloomberg today. I didn't hear about this, that this was a thing, that people have been wondering about the trading activity that took place at 7:29 a.m. Central Time yesterday, in the minute before the CPI was released. And so I know the White House press secretary got asked if it was leaked. I mean, they don't know anything about that. I'm not saying that they do. But it is interesting. I went back and looked. I don't have the minute data for back at previous ones, but there were much more volume. So ES spiked about 1% on 4,000 contracts, but the ZN, 13,000 contracts traded in that minute before, which is unusual. And it went in the direction that was shortly thereafter established as this like blow off top that came right back. So what do you think about that? I know stuff like that has happened before, where usually by mistake, do you recall this? I remember like back when I was trading like 5 to 10 years ago, something like that, there was a unemployment number that somehow some doofus managed to put it out or something like that. I don't understand why they even do these embargoes. So just so you know, on these big numbers, you might be like, how can these news agencies get these short stories out so quickly after something like unemployment? Like a minute later, they're out. And it's because I believe they still do this, and I don't know why. There's some like embargo time where they like lock everyone in the room. And JD, tell me if I'm talking out my ass and you're like, we ended this years ago. But I believe that there's like a bunch of reporters that get like locked in a room, take away their cell phones, and then they give them the numbers so they can start writing the stories, and then can't release until 7:30 Central or whatever the number comes out.
That sounds pretty accurate to me. I have heard this also. I don't think the practice has changed. I could be mistaken also. So no, I do not think you're speaking incorrectly.
No.
I was going to throw an expletive out there, but yeah, and it's when you see that kind of price activity happening the minute before, the conspiracy theorist in all of us says, yeah, automatically this number was leaked, who let the cat out of the bag kind of thing. So it is questionable activity, but
it would be hard. I think it's something interesting. Now, a lot of times when stuff happens, it's lower. There's going to be lower liquidity and stuff then. You never know what, I think I said this a lot on the show, is you never know what some entity is hedging, right? You get filled on options or whatever other derivatives you're using, and then you're like, wow, I need to get flat get flat delta right now.
It could have just been the new guy getting lucky with a fat finger too. You really never know.
Yeah. What makes me not think it's a conspiracy is you'd have to be, that is the most obvious, right up there with like a pump and dump, the most obvious form of market manipulation. It's not like you're not going to get asked questions. If you were to trade, 10,000 ES futures at a huge profit 1 minute before the number, you're going to attract attention, and they're going to find out whether you got that number beforehand or not. So it's not worth going to jail over. That's the biggest thing. Not. We talk about not blowing out accounts, managing your risk. Managing not going to jail is an underrated part of trading. That is the bare minimum you should do. And we've seen a number of people, including our friend SBF, kind of ignore that advice. So going back to that move, huge move off of CPI yesterday, came in cooler than expected. We have the added info of the Fed talk today. We were interested in discussing, because we had a Make Hogue Money yesterday with Anne-Marie Ban, and she does a lot of her trading around options data and big technical numbers, and is pretty patient with those. And one of her trades paid off really well. So when you have these huge knee-jerk moves, you want to get in a trade. And we're kind of thinking about what are the big levels to look out for at that point, so that you're not just kind of chucking things into the market. JD, I'll let you go first with any thoughts you have, and then I'll throw a few as well.
Yeah, first of all, if you're not used to trading in times of high volatility, you might want to take a step back, just because for some people, for inexperienced traders, if you're not scaling back your I guess your time frames and not getting a look at the broader picture. It is akin to just basically shooting from the hip and trying to get lucky on a couple trades here and there. So I just it's something I can't get behind. I did it myself. It doesn't work. So I would recommend trying to stay away from that type of trading. And in the spirit of that, I would say first thing you have to do is look for those broader levels. If you watched, we could throw a link. No, we can't throw a link. I could throw a link to Anne Marie's broadcast yesterday, but she talked a lot about those weekly and monthly levels, going back, looking at those broader, longer term highs and lows, the longer term swing highs and lows, areas of previous congestion, areas of major previous congestion. Those are the types of levels you want to, I would say, you want to be looking for. If you're looking at a 30-minute chart, trying to trade what happened during that CPI number yesterday, or a 15-minute chart, I should say, you're just not getting a look at the bigger picture, and you need to sort of take a step back and look for those bigger levels, the longer term moving averages. Yeah, just
Right.
expanding time frames.
I want to talk a little bit too about, yeah, that's why you always got to start with at least your daily chart and going back. I want to talk a little bit about why, and I've put them on my charts as well now, just to be more cognizant, because the really great trade that got done yesterday to make Hogue money was off of, I believe, the previous monthly high at 40.95. That was what we got filled in. We almost top ticked the market there.
Mm-hmm.
And the reasoning behind it, we've been talking options before, is I think what makes especially these monthly high lows, the highest close, stuff like that, important has to do with understanding sort of how options work, right? And you can do some of this with the volume profile, market profile as well, but there are monthly options expirations. And these sort of, I hate saying smart money, but like the big money, the market makers and things like that, and options are going to they're trying to minimize their pain and trying to maximize the pain of others. And so as those expire, they're trying to get the prices that are important for them as far as their books and things like that, more so than some random wick. So the monthly close, that's why it's important. And people will be reevaluating on a long term, not even a long term, but evaluating what's important and what do I believe at those points. So I think that the month high, low, and open are a great thing to have in your charts and to look at. The other one is we did end up just closing today, and you guys will know what happened tomorrow, but we closed today pretty much right at I can't even tell the difference on my chart between, it looks like we closed almost exactly at the 200-day moving average for the ES, which after I read initially what Powell said, that he was the Fed was hawkish in the announcement. They did the 50 basis points, which was expected. That's a slowdown from the 75 basis points. But the expectation for what the terminal rates are went up because they are still beating the drum of inflation, where I think we probably have crested, but they don't want to see asset prices get out of control and kind of ruin everything there. Did you have any takeaways on any of the Fed stuff today?
Just a little bit. I mean, between the Fed raising rates, we still have year over year, CPI showed inflation was up over 7% year over year. Hourly wages down year over year. Those are significant things moving when you're looking at these rates moving forward too, I think. So even though he was talking a little hawkish and maybe starting to curb, hinting at curbing future interest rate hikes, I still think that we're not quite out of the woods yet as far as inflation goes.
No, they'll have to keep on. I think what he risked the most is losing the authority It's sort of like one of those. I'm not comparing any of these people to mobsters, but it's sort of like mobster movies or something like that, where you have to be given the you got to seem like you're in control of the situation, even if you're, a guy Joe Pesci's size or something like that. The second you let your guard down or look soft on something, it's almost like prison rules or something like that. People will take advantage of you. And I think that that's what's happening now. If it weren't for sort of market expectations, asset markets. So I'm thinking specifically, I'm thinking bonds and stocks right now, treasury bonds, which are both going bid, right? If those rate expectations lower, is he's got to tell them to pump the brakes because it'll ruin everything. Like say we had, and this is one thing that would make me feel on a longer, if I was like a swing trader, a little better about going short positions. I mean, he does not want to see the S&P go back to like 4,800 or something like that, because it would just undermine everything he's saying. It would just basically mean markets are calling your bluff. They're saying, you're not going to do this. You're not going to hold them long. You could already see this divergent. They released their dot plots and the market expectations based on the yield curves. It'll never, I'll never not be messed up because I have mirroring on my Zoom. So I see my hand go out and it's going this way. I guess I want, okay. The expectations of the market for what future interest rates are going to be in Fed cuts is completely decoupled from the Fed dot plot. And there's even some jabroni on the Fed who has like a 5.5% Fed rate in like 2025 or something like that. I don't know if that's helpful, but they voted unanimously.
They did, yeah. That would have been yeah. They voted unanimously on it.
That's a hard word to say. I cannot talk right now. I'm taking a sip of water. Yeah, so that's others. Oh, go ahead, Jay.
I was just gonna say, circling back to I shouldn't have said that. I hate saying circling back, but that ties into sort of what Anne Marie was saying in her broadcast yesterday. Also, she made a great analogy about setting up your chessboard for the day. You have your game plan ready, but it's good to know what everybody else's game plan is to what they're watching, and this all ties in together.
And if you look at some of those options, things like, I know that you can get the max pain for market makers and stuff, and things like the SPX, you see where they want things to go and where they don't want them to go. And I think that's important information to have, where it's going to take a lot of effort to get option market makers away from the place that they want to go there. Likely something exogenous, right? Something unexpected happens. And they're not always right. They're going to lose money sometimes, even in the way that they hedge these things and get back to them. But you see where they feel most comfortable with things going at the moment. And that's why looking at something like the put call ratio or the put premium versus options premium is interesting, because then you know where people are thinking this is going to go and putting their money behind that bet as well. So beyond the moving averages, so 50, 200-day moving average, month, open, close, high, low. Beyond that, you can look at things like we did earlier in there. You got to go back in time on a longer time frame and check out previous bottoms, tops, gaps, especially. We don't have many around where we are now, but I know that was a huge thing after COVID when we were taking off. We had all these gaps that never filled. And that's with the CPI number yesterday. That's what happened. Textbook gap getting filled. It had this huge acceleration upward in the equities with this sort of euphoric, hey, we finally came in cool on inflation. And then I think people are like, wait, it's not the inflation number that means anything. It's what the Fed does tomorrow. And he doesn't want to see the asset prices rally euphorically. So, oops, time to get out. And then it came crashing back down to around the month high from last month, I believe. Let me take a look at my chart real quick.
Yeah, it was. Just mentioned that a minute ago. Well, we took out the high from September.
Yeah.
during that spike higher, which was at 41.75. This is on a continuation chart also I'm looking at right now. So,
I mean, if you go way back, like if you really, you're talking about like important levels and stuff like that. If you go way back in the ES to like the highs of last year, right? You almost have an exact straight line of lower highs. Like it's almost like I hadn't like scanned out and looked at this perfectly. This I think is another reason why we're kind of sticking in this range here around the 200-day moving average, right? You have this
mhm,
line that pretty much has 3 touches, and this is the 4th right here. And that signals that this is a level that everyone's thinking about.
right.
This is where I wouldn't get too hyper about sticking with conviction one way or another, because if it, if it pivots lower, I think that that's just sort of a continuation of the pattern. But we did have, as I mentioned, the bottoms, we had almost 3 touches, but then we had that sort of almost like the bottom of a bowl or something like that. So we haven't, that pattern has kind of ceased to exist. So I think to be like powerfully short, you got to see that 3,600 get taken out at some point.
Mhm. We're still in a pretty low risk entry level to be short right now too. So, keeping a close eye on volume and open interest uh, in the short term is something to consider also.
I think so too. There's a lot of things being short right now. There's not the fear. If you think about last year, you'd have to be mad to be short, because there just was so much froth going on. But as long as Powell is speaking like he does, that's the one big, it's like the opposite of the Fed put, kind of saying like, no, it's not going to go too high. And then beyond that, you have a lot of tax loss harvesting as we get into the end of the year. And by the way, if you got losers to get rid of, now's the time to do it. Get those, not in the day trading time frame, obviously, but say you got some Wayfair stock or Tesla or Meta, the company formerly known as Facebook, or I can just name the entire NASDAQ 100 right now. Yeah, maybe look at some tax rebates there. Cool. So yeah, we've talked about past points of congestion, and those to kind of like finish up here. Once you get that list, don't force yourself to trade unless one of those comes into play, especially when things are going crazy, going back and forth like mad, and people are looking for something to stick to. They're not going to do it at some crappy level, right? That might matter in a much slower market, right?
Mhm.
They're only going to care about where the fights are going to happen are at these big important levels, and everything
Yep.
else, it'll come or it won't. But don't force the trade just because there's a lot of stuff going on.
Yeah. You could also take, I think, an underutilized tool that many platforms offer now is the delta chart that shows the
Mhm.
sort of the scale of market buys and market sell orders coming in at each price. This is great for shorter term retail traders also. If you're only in there for if you're if the market's moving and you're looking for that quick fade opportunity, that's something you might want to look into also. When you see those numbers start to get a little lopsided, possibly looking at a momentary change in direction. So if you're not savvy with the option game, uh, yeah, those delta charts might be what you're looking for also.
But yeah, I encourage you, even if you just trade futures, maybe learn a little bit about options and how they affect market pricing for things, or at least the basics. You can
Hmm.
get your PhD, and many people have, in options pricing and things like that. But you don't need to be, Black Scholes over here. A little bit will go a long way. So at least you don't get run over. I feel like when people make bad trades at bad levels, sometimes it's out of, the word's not ignorance, but like not not knowing, right? Just getting run over someplace because they are not aware of a very important level that is lurking somewhere else. So I think it would be beneficial to spend time looking at the longer term charts, and things will go a lot better for you. So, JD, you got any parting thoughts on this? We're coming to them from the past. So do we want to like talk about some end of the year stuff?
What are we going to make predictions?
Let's see.
I should have come prepared. I think I could pull up our blog from last year.
Thankfully, I think
see-
I was out of town when those predictions were made. So I think I missed last year.
I'm just curious to see
Well,
how we did.
See if you can find them, by the way. Let's make that for next week. We will find those, and I will, even if I'm by myself, I will release an addendum holding task to us about who made what predictions and who said Bitcoin 100K. That was you, right?
Did I say Bitcoin 100K? Yeah, I said Bitcoin 113.
Oh, okay. Well, the 13th.
But nobody, everybody was right around 70, 90. What else do we have? I had S&P 4550 to close the year.
Not bad.
Hogue had 6,500.
Ooh.
Uh,
Did I give one?
no, you were out. So
Oh.
I made picks in your stead. But
Oh, well, thank you.
sure.
That was a reasonable one. We could still hit 4,500 at the end of the year. Powell would not like it though. So, JD, thanks for stopping by today.
Yeah. This was great. Thanks for having me.
Yeah,
I always enjoy talking with you guys.
Yeah, we'll bring you again. We'll bring you in again sometime. Can't speak English at the end of the day. So, yeah, thanks, JD. Thanks, everyone. We'll have limited programming next week. We'll have Coach's Playbook. We'll have the forecast and recap. And then we'll be kind of wrapping things up for the year, given that Friday next week is Christmas Eve. So, no, the day before Christmas Eve. So, everybody out there, have a happy. This is getting absurd. Take a sip of water again.
While you're taking a sip of water, just want to let you know, this week will be the final weekly kickoff of the year too. But if you haven't subscribed to it, go to our website, subscribe for the weekly kickoff, because we've got a whole new fresh look coming out for the first trading day of the year. So
Sick.
keep an eye out for that.
You know what I think it is I have trouble talking if you have these monitors on where you're hearing sort of a recorded version of yourself.
Mm-hmm.
It's difficult. I could never do morning radio or something like that. Anyway, have a great holiday, everyone. Stay safe. Trade well. See, now I'm so in my head on it. All right, everybody out there, stay safe, namaste, and trade well.